Good morning, everyone, and welcome to the Bowmans, the first Bowmans budget webinar. It's the first time we're hosting a budget event on this platform, and we're really pleased to have so many people from across the country joining us on this platform for this event. For those of you that don't know me, my name is Yasmeen Suliman. I'm a tax partner at Bowmans. I'm based in the Durban office. I moved from a Big Four firm 2 years ago, just over 2 years ago. I'm not an accountant. I'm not a lawyer by training. I'm an accountant. It's quite strange for me to be part of a law firm, and I'm very pleased to be part of a vibrant team that really stimulates thought and really pushes you to be the best that you can be. Before we start, there's some housekeeping issues that I just want to clear. Except for the presenters and the panelists, all attendees are on mute. You are able to raise questions in the Q&A function or in the chat function. Michael and myself are the main presenters today, and we're happy to entertain questions as we go along. And for all those questions that we aren't able to discuss during the course of the presentations, we'll deal with at the end of each presentation. Just from an admin point of view, this presentation is being recorded. It will be available on our website, probably by the end of this week. The PDF versions of the presentations will also be made available on our website, probably also by the end of this week. From a further admin issue, CPD certificates for attendance will be issued. I did notice that some attendees didn't put in their full names when they registered. Where we do have full details of the attendees, we will issue those CPD attendance certificates. If you do not receive your certificate by the end or by the middle of March, please do contact us and we'll make sure that gets to you. Please do forgive any technical glitches along the way. I have to admit to feeling my age. I'm not as tech savvy as my kids are. So if I end up pressing the wrong button, please do forgive that. And certainly hope that you will enjoy the session with us. Now, the past 11 months have been quite a difficult period, I think not only in South Africa, but worldwide. And in particular, the last 3 months have been very somber. I don't think anybody was really able to enjoy the December break. I don't think anyone has been untouched by this pandemic. We've all lost either friends, family, clients, colleagues to this pandemic. And I'd like to take a moment for us to just remember those people that were lost during this time. Thank you. I hope we all get back to normal soon. It certainly has been a difficult period of adjustment for a lot of us, not being able to interact with many clients or interact, in fact, with many people, having to maintain our distance. You know, last year, this time we had our physical budget speech event in Durban. And there's two things I really miss about a physical event. The first is the pastries. I really enjoy the sweet things, and that's clearly missing this year. And the second thing I really do miss is the human interaction. You know, I'm not known to be the most sociable of people, but I really found in the last few months that having it taken away, it has been quite obvious how much humans need to interact with others. And having a physical meeting or a physical event is far better than having a remote one. But there is a silver lining. This year, you know, we wouldn't have had a webinar unless the pandemic pushed us into it. And the way that technology has been embraced has certainly made working life a lot easier. Certainly from a silver lining perspective, we're now able to welcome attendees to this event from across the country, whereas with a physical event, we're obviously quite limited as to who can attend. For the last 13 years, since 2009, I have presented a separate budget speech event every year for the Association of Muslim Accountants and Lawyers, also known as AMAL, and the Minara Chamber of Business in Durban. And And these two organizations are sponsored by the Al Baraka Bank, which is the only fully fledged Islamic bank in the country. This year, the attendees from Amal, Minara, and Al Baraka are joining us today. So I'd like to extend a warm welcome to those attendees as well. Now, as you all know, the budget speech was read yesterday by Minister of Finance, Tito Mboweni. What you may also know is that the minister is also of noble stock. According to his Twitter handle or Twitter profile, he's also the Duke of the Duchy of Makovaskloof. Some people may say that he's got delusions of grandeur, and for those of us that were pleasantly surprised by the tax proposals yesterday, we may say, well, actually it's a well-deserved title. Now today we have two presentations broadly. The first presentation is going to be done by Michael Hewson, who is going to be dealing with the macroeconomic position and the impact of the budget proposals on the economy. Before I hand over to Michael, I'd just like to say a little bit about him. Michael founded Graphene Economics in 2017 with a vision of creating a specialist economics-focused African transfer pricing firm. In 2019, the company was recognized by the International Tax Review as a Tier 1 transfer pricing firm in South Africa. Quite a remarkable feat for a firm that was only 3 years old at the time. He has over 15 years of experience in transfer pricing in Africa and was previously a partner at EY. He has an MCOM in financial economics, an honors in econometrics, and a higher diploma in tax law, and has contributed to 2 books on transfer pricing. He's also a guest lecturer at the University of Johannesburg and the University of Pretoria. He's a member of the South African Institute of Tax Practitioners, where he's also a member of the National Tax Education Committee. And without further ado, I would like to hand you over to Michael, who will take us through the economics piece.
Good morning, ladies and gentlemen, and it's a real pleasure to be with you here today. I'd like to start by just expressing my gratitude and thanks to Yasmeen and the partners and the executives at Bowmans for organizing this event and for the invitation to join you. I'd also like to just thank my team for helping with the preparation for and the research for what we're doing. So it's my team at Graphene Economics and Greg as well for all of your input along the way. I'm going to just take a moment and get the slides up and running, and then we can be good to go. So as Yasmeen pointed out, it's a pity to not be able to be with you in person like I was last year. But by now we've all had the opportunity to embrace the webinar culture. So I'm really hoping you've all got your cup of coffee and you're ready to go. I'd like to reiterate Yasmeen's suggestion and encouragement to make this as interactive as possible. So please post your questions or your comments as we go along the way. And let's try to encourage some debate throughout these discussions. Now, the Minister of Finance, he's no visitor to having to drive the economy through difficult times. You will remember that he was the governor of the Reserve Bank shortly after the dot-com crisis, and he, together with the former minister, Trevor Manuel, had to guide the economy through a challenging time. And we experienced a period of good growth for a number of years. So he's no stranger to these difficult circumstances. This one, we must acknowledge, is considerably different to what he experienced previously. So in the budget yesterday, the minister had arguably very little to work with, but he needed to give a really strong message. He needed to give some really good direction. And in order to evaluate that message from an economic point of view, what we're going to do is we're going to first spend just a little bit of time this morning looking at the key features of this crisis. What is it that differentiates this crisis from other crises? Because only by understanding that can we really appreciate how to address it and how to move forward. We're then going to spend a bit of time on the economic fundamentals that were facing our country prior to the crisis and that are still facing them now. Then the question is, where to from here? And that's the chain of events that we're going to look to follow in order to assess this particular budget. So hopefully these slides will move on in a moment. Professor Nouriel Roubini is a professor at the New York University. And some of you may remember that he was regarded as Dr. Doom many years ago. He was the person who most accurately forecasted the 2008 global financial crisis. Now, Professor Rabini has over the years, he's put together a lot of literature on crises, looking to understand the differences between crises. And what he's articulated is that each crisis, whether it was World War II, the Great Depression, the oil crisis, the subprime crisis, dot-com crisis, they all had different trigger events and different outcomes. And using his framework that he used to identify, or that he identified in relation to these crises, what we have done is we've tried to work out what are the chain of events and what's the order and the interlinking between different features for this particular crisis. What you can see here on the screen is that the crisis, as we all know, started as a healthcare shock. That led to very quickly a supply chain shock, which spiraled into a financial market shock. And lastly, that impacted the real economy. As I said, this chain of events looks different for different crises. So let's drill down a little bit further to look at the implications for each of these events. Firstly, from a supply chain event and perspective, it was interesting because in May last year, Bloomberg News ran an article saying that the crisis of 2020, COVID-19, had the same impact on supply chains as the global financial crisis of 2008 had on the banking sector. In other words, it caused havoc and extreme disruption. We saw that, I mean, many of us after the president's announcement that we were going into a hard lockdown, first thought was, let's go and check my pantry. How many rolls of toilet paper do I have? Let me go and get some more. And lots of things were missing on the shelves. And we saw that trucks, ships could not get across the border. There were real constraints on the supply of goods, demand for certain goods and products. That spiked, while demand for other products like tourism, restaurants, that fell. So there was a big shortage of goods. There were also other anomalies that we saw. Things like negative oil prices in terms of US dollar perspective. Divergent demands and impacts in different sectors and industries. That was the supply chain impact. As I said, it spiraled into the financial markets. We saw a massive and dramatic sell-off in financial markets, and there wasn't even a sharper bounce back in time. Also, different industries reacted in different ways. So the tech sector, tech industry, that increased really nicely. Other sectors, airlines, for example, significantly decreased. There was a retreat initially to safe harbor currencies, the stronger currencies, and other things, other anomalies like the rise of retail trade, where consumers are sitting with lots of cash, wanting to know where to spend it. Well, consumers in some markets sitting with lots of cash, wanting to know where to spend it, driving certain other behavior. This also led to implications for the real economy. We saw a decrease in supply of goods and services, a decrease in jobs. There was a very significant emotional impact that came with all of this turmoil. Another important factor, which we'll discuss more in detail and which was alluded to in the budget, was a dramatic impact on consumer spending, decrease in profits of companies, and decrease in government's revenue collections if you look at the year as a whole. So in order to protect economies, stimulus packages were announced and provided in order to protect the real economy in particular. What we saw with these stimulus packages is it's encouraged and invigorated and gave some hope to these different aspects. Now, the real economy got impacted last. The supply chains and financial markets, many of them could bounce back first. So as we opened up our borders a little bit and allowed some movement of goods and services, trade continued. What was interesting is you'll remember that, I'd never shopped online, for example, always gone to the grocery store. But now I started shopping online, expecting deliveries. But this increased exponentially to the point where consumers now started expecting same-day deliveries. So there was a real drive in terms of change in supply chains and the way that even consumer goods companies needed to respond to this. Rapid use of technology, driving this. It was interesting because the CEO of the Microsoft Group, he said it in May last year that what we saw was the increase in technology in the first few months of last year was basically the increase we would have expected over a 2-year period had it not been for the crisis. So technology was used to address real constraints in the supply chain sector. Financial markets, big surge in liquidity. We'll look at the numbers just now. That pushed asset prices up considerably. Partial return, we saw in the second half of last year, return and improvement in the rand, for example, and certain other developing countries. Inflation starting to, in the last couple of months, there's more talk of could inflation be a risk, etc. The real economy, social spending increased. There were various different measures. I mean, we'll remember in South Africa that the banks, that they were allowed to basically agree to give extended terms for paying interest rates, etc. Other extensions of repayments terms and conditions were given, and there was significant spending on healthcare, etc. Short-term health facilities set up. What was interesting, though, is that the big divergence in the impact and the recovery and rate of recovery of financial markets and the real economy, that's only further exacerbated the levels of inequality. People who had money in financial markets benefiting from the last few months, whereas the real economy really battling to recover. It's interesting. I mean, so the COVID-19 had a significant crisis, had caused significant disruption to a lot of different areas. And it's interesting, we've put a few statistics up on the screen here. So if we look at this time last year compared to now, COVID-19 confirmed deaths just a year ago, 310, whereas now it's considerably higher at over 2 million. The value of Bitcoin, some argue speculative, others argue perhaps more value, but I'll leave that up to you. The value increased from $9,000 to $35,000. The number of international flights by the airline industry, 38.9 million down to 16.9 million. Interesting stat, Elon Musk's approximate net worth, 28 billion up to $183 billion. Well, that was up to a couple of days ago. The JSE All Share Index had a terrible first few months, but recovered really, really strongly to the point that it's actually in a better position than it was early last year. Change in consumer behaviors. Netflix, for example, Netflix subscribers, that increased. This last one has absolutely nothing to do with the COVID pandemic, but we thought it was interesting nonetheless. Collective rainfall in South Africa, 193 mils by the 1st of Feb 2020, by the 1st of Feb 2021, over 1,000 mils of rain, just to add to the chaos. But the interesting thing is that every country and every industry experienced 2020 differently. So if we look at the map here, we can see some of the implications. On the right-hand side, China, they were the first country where where COVID was identified. Arguably, they were also the first one to get through the first wave after a very strict lockdown. Czechia, they have the most cases per million population for countries with a population over 1 million. The UAE have the most tests done per million population. Belgium, most COVID deaths per million. The USA, the highest in the total number of cases. Sub-Saharan Africa, it's the region with the lowest COVID death rate. Now, this was potentially a better surprise than many had expected. There were great concerns in the beginning that because of the environment and the circumstances in Sub-Saharan Africa, it would be difficult to social distance. And the reality is that was the case. What has really helped with the number of the lower number of deaths in Sub-Saharan Africa is the lower average age of the population in Sub-Saharan Africa. So that has been a blessing in disguise and has assisted in this period. So it was the impact of the pandemic being varied across the different territories. But there's also been different responses to the pandemic. In terms of the vaccines as a starting point, some countries been very pro and very keen on that. Certain other territories in parts of Africa, for example, people have said, well, we're not getting vaccines at all. And lots of concerns and speculation around that. Stimulus packages have also been very varied. In some countries, they've had capacity to inject significant stimulus into those markets. Others just have not had that stimulus. What the graph shows here in different degrees of shading is those that didn't put any measures in place, those that recommended some measures in terms of stay at home, some that required and said you really need to stay at home unless there are exceptional circumstances, and others where it was extreme lockdown, where you really could not move, and it was extremely policed. So we see South Africa and parts of Southern Africa, it was required to stay at home, but certainly not everywhere. What was interesting is this meant that the implication of this is that it had profound impacts on different industries and sectors. By way of example, South Africa's lockdown was relatively strict. And what this meant is many of our borders were closed, or they were very constrained. And so the logistics and transport sector in Mozambique, for example, benefited. They were not as locked down and constrained, so a lot of shipments were diverted through Mozambique, and the transport sector there benefited for a period of time. One of our other neighbors, on the other hand, Botswana, also not as strict, but they were really badly impacted, not per se because of the virus infections, but their economy was impacted because they're a landlocked country and they couldn't get the goods from the other countries. So countries that, just because their geographical position or their response or other factors, caused them to be impacted very differently. Industries, as we've touched on already, different industries have been impacted in different ways. Many of you will have seen this graph. I still find it staggering. Here we are all gathered using Zoom, and the market cap of Zoom got to a point where it exceeded the market cap of the top several airlines. With tangible physical assets, here a tech company increased the market cap of that. And we saw this even within companies. The opportunities, in some cases, for one division in a company was considerably better than another division in a particular company. This has profound implications on the profit and the revenue generation side, but also on the tax implication side. And the fact that the response and the impact has been different in different markets, different industries, and down to different companies is something that revenue authorities, we also know, are aware of in terms of, and a discussion that I had with someone from the Uganda Revenue Authority last year during a panel discussion. He pointed out that it's going to be really important, even from a tax perspective, to be looking at what was the impact of this pandemic on this particular company versus this company. Did this company, Company A, did they need to provide funding and share costs and share resources with another company? Maybe they did, but for another company, the circumstances might have been different. So there's profound implications of the way that the pandemic has impacted businesses and countries in different ways, down to the level of even expectations in terms of tax to be paid by those different companies and industries. This is some analysis that was put together by Standard Bank, and it looks at a really fascinating and profound implication of the crisis. It relates to the stimulus packages put forward by a number of the big markets. So what you can see here is the stimulus that's been committed as a percentage of GDP. And in blue, you can see that the percentages are the amount as a percentage of GDP compared during the time of the global financial crisis. In orange, you can see the stimulus package granted now. For the US, the stimulus package granted is up to approximately 25% of GDP, considerably higher than that during the global financial crisis. Likewise, with Germany, Japan, France, Italy, China, UK. This, as we will discuss later, is profound and does have big implications for the direction going forward. Unfortunately, not all countries have had access and opportunity to grant similar stimulus packages. In the case of South Africa, for example, we'd announced 500 billion worth of stimulus packages. Not all of that has been has materialized or been able to be transferred. Some of that was identified previously, but if we look from a global point of view, the amount of liquidity is considerably more than it was previously. So as I said, the pandemic caused tremendous shock across the global economy, and now it's relevant in order to understand the implication on the economy to take a moment and to look at what are the economic fundamentals that we're facing South Africa pre and post-COVID. But before we do that, I'd really like to get some responses from you and some feedback from you. So we've got a polling question that we're going to put up, and I'd like to get your responses from this. The minister announced yesterday that the South African economy has declined by about 7.2% this past year. How many years do you expect it to take GDP to recover to 2019 levels? Is it going to be 1 year, approximately 2 years, 4 years, 6 years? Do you expect, again, negative growth for this year? So take a few moments and just indicate your answer, and then we'll look at what the sentiment is at the moment, and especially in light of yesterday's budget. Okay, interesting. So 1 year, no one's that optimistic. 2 years, there's a couple of optimists in the room. 4 years, that seems to be the general consensus. 6 years, and then there's some people that are very concerned about the current crisis really continuing to impact us negatively. The reality is, depending on who you ask, you get different forecasts, as always when speaking to any economist. So let's have a look at the economic fundamentals of the country. So what we should bear in mind is, even pre-COVID-19, South Africa was facing periods of very constrained growth. But the global economy was also facing levels of lower growth than previously. On the left-hand chart, you can see we've got a selection of 6 countries, some in developed countries, some in developing countries. And you can see over a period of time, from 2013 to 2019, that the levels of growth for those countries that's ebbed and flowed a little bit. For the past couple of years, certainly for 2019, a number of them were lower. The growth was lower for the global economy compared to 2018. We then had the big shock of 2020 that took us into to negative territories. The last a few months of the year, helped to improve what was looking even worse in South Africa. What's interesting is, when considering South Africa in the context of the globe, countries like the UK, they are noted as having had the worst year in the last 300 years. Now, bearing in mind that they were in the middle of the 2 world wars and Great Depression, they experienced all of that, but this for them was their worst year. It is anticipated that the UK and the EU are likely to bounce back and recover relatively quickly. So it's expected that they will recover in approximately 2 years to their 2019 levels. In South Africa, on the other hand, it's expected, if you look at a Treasury forecast, to take in the region of 4 years. Some of the banks, they're anticipating on a really good case, best case, maybe 2 years, worst case, 6 years, but moderate, middle of the road case in the region of 4 years. The fact that our economy, the size of our economy, is knocked back by so many years it is very concerning. Another important consideration is the makeup and the composition of our economy, and this we will address in more detail a little bit later. So we can see manufacturing still a large portion of the economy. Now, this was obviously hit really hard when factories were closed, people couldn't go to work, and factories to a lesser extent can move to working online and remotely. People have to be in there. So a hard lockdown has a big impact on the manufacturing sector. The mining sector also likewise hit extremely hard. Again, there's a little bit of good news coming out because of the commodity price growth that we will talk to just now. But the structure of our economy does have an important implication for the potential response going forward. Wealth is an important criteria because or consideration, because it talks to the level of that the consumers have to respond and to see through crises. What you can see is in South Africa, for example, much lower GDP per capita levels than obviously the developed countries, and our GDP per capita also impacted negatively during this last year. Again, like you'd expect with the previous slide, it'll take potentially 2 to 4 years, 3 to 4 years to recover. Unemployment. There's been a lot said about unemployment, and the Minister spoke about this. The President in the State of the Nation addressed unemployment as well. The levels of South Africa's unemployment are staggering, and this puts a severe constraint on our ability to respond to a shock and a crisis like this. Any further exacerbation of the unemployment levels, it just puts a lot more constraint on revenue collections on across the entire economy. Our level of unemployment has increased considerably during this past year. A number of the jobs that were lost at the first stages of lockdown have not yet been recovered, and it's expected that it will be a long time before they are fully recovered. Another important consideration, we touched on it earlier when we spoke about the divergence and the impact on the financial markets versus the impact on the real economy, is the inequality. Now, we're already sitting in South Africa with a situation of extreme high inequality. This is only exacerbated by a pandemic such as this and a crisis. Government spending, another relevant consideration. I mean, what you see in the graph says government spending as a percentage of GDP, it's naturally spiked and increased as a result of last year and the need to assist and step in and help support various sectors of the economy. This has a direct bearing on something that we'll discuss just now, which is one of the really big constraints of our economy, which is our debt levels. Obviously, the greater the government spending, it really hurts on the debt, and the debt is a factor that prevents us or constrains us from considerable stimulus opportunities. Debt levels here. Now, what was interesting is if you have a look at the graph on the left, the dark blue shows the 2019 budget, and what you can see is how the debt levels as a percentage of GDP in the 2019 budget, it was expected to taper off at about 60% government debt to GDP. Then when we had the midterm budget policy statement, you could see the light blue graph, it increased, it spiked considerably, it diverged a lot from the previous trend. A positive is that in the last couple of months where we saw the revenue collections from SARS being a bit higher than expected from in October last year, and those collections attributed to a few different reasons. We also saw the economy just doing a little bit better than expected. What we've seen is the projections and forecasts of debt as a percentage of GDP just recover very slightly. However, it is still extremely concerning our levels of debt to GDP. If you look from a comparative perspective, you can see our debt to GDP ratio increased considerably. What you may find interesting is that certain other countries, the UK, the USA, their debt to GDP ratios are really high. But yet, if you think back to a few slides earlier, their stimulus package is incredibly high, and yet we were constrained. There's a couple of reasons for this. So the one is that many of these countries, they had a better growth story, that there was better trajectory of the economy, so better perceptions of the economy. Consumers also likely to help the economy recover much quicker. There's in many ways more certainty for those economies than for us. So our debt levels are a particular inhibitor for us in South Africa at the moment. An important consideration has been the interest rates, so the cost of funding. These, as we've seen, I mean, they increased over time, but then in the last year they came down quite considerably. In fact, there were several reductions in the interest rates. It's in line with the trend that we saw in many of the countries. But what this has meant is that it's certainly given some relief to business, to consumers, etc., to assist in supporting them during this time. Now, the maneuver by the Reserve Bank to look at reducing rates had it was critical. It was really essential. What you can see on this slide is, as you would expect during a crisis, the number of impairments on debt and outstanding loans and balances, that was increasing. It was increasing very sharply and getting to dangerous levels. With some of the interventions by the Reserve Bank, that then tapered off quite considerably. So the reduction of interest rates and other measures by the Reserve Bank helped to steady that trend line in terms of impairments. So it certainly did a lot of work to avert a potential banking crisis. Now, these two charts are really important for the way forward. What you can see here is that the levels of consumer savings in South Africa for a number of years have been bad. In 2019 and 2020, they also bad and low. And what that's meant is that we haven't had the opportunity to increase consumption expenditure and drive the economy. Now, you'll recall that I said just now that the UK was hit really hard, the EU hit really hard, but they're expected to bounce back relatively quickly. A big part of the reason for that is what you're looking at on the screens here. If you look in 2020, for example, on the right-hand side of the screen, what you can see is the comparable household savings in many different markets that increased considerably during 2020. The reason for that was simple. People couldn't travel, they couldn't go on holiday, they couldn't eat out as much. And so in much of the developed world, there was this big amount of consumer savings. What that means is that as vaccines get rolled out and lockdown gets released, they will be able to get very busy with travel plans, with eating out, and that will really kickstart their economy in really considerable ways. In South Africa, what we faced is obviously having very high unemployment, having great dependence on a few people. It meant that when many people lost their jobs, there was great dependence on the consumer to assist family, friends, and lots of pressure overall. We did not see the same increase in consumer savings levels. What this means is, on our own, the consumer market is not likely to have the same bounce back in terms of travel and restaurants. There will be a little bit of bounce back, obviously, when lockdown gets released, but we don't have the same saved up savings that many other markets have. So what this graph means and tells us is that we really needed some sort of stimulus or encouragement for consumers in our budget. Another very relevant aspect is the perception of the different economies, and this can be seen in the 10-year government bond yields. So you could see it was high, and then in 2020 in South Africa, it increased. Concern for a number of different factors, unemployment being a really big one, job losses, the economy as a whole, some other news stories as well impacting this. You can see in 2020 the spike on the right-hand side for South Africa in terms of perceived risk was higher than in a number of other countries, which seemed to almost be they weren't as impacted as much when everyone considered the global picture as South Africa was when they considered the potential impact on the economy of this crisis. The Minister of Finance, he spoke yesterday about foreign direct investment and how do we encourage that? How do we stimulate that? It's interesting that the President also in the State of the Nation address a couple of weeks ago, he also reiterated that we need growth-led FDI. You can see our levels of FDI did increase over the last few years. The President himself, he was very active in trying to drive FDI into the country. 2019, it tapered off a little bit. There's another area where we really need to look to focus on, going forward, and in order to come out of the, in the best possible way. An important consideration, and we won't dwell on that in too much detail, is the state-owned enterprises and the output for the input. And there what you can see is the debt levels of Eskom on the left-hand side as a proxy for many of the other SOEs has increased considerably over the last several years. It was interesting to note that there wasn't too much support mentioned in the budget yesterday for SOEs in terms of any further bailouts or anything like that. So again, it certainly seems to be something that the minister is very conscious of, seeing how do we taper that off. But if you look on the output side, despite the increasing debt levels, which has been a tremendous increase from 2013, the electricity production from 2011 to 2021, that has been declining over time. So big constraints and challenges even that inhibit productivity. Having said all of that, we should not lose sight of a few of the pleasant surprises that we have seen in the economy. Firstly, if we think all the way back, I remember this time last year, one of the points where we touched on was potential ratings downgrade and what impact that would be. Well, the impact of the ratings downgrade, that had relatively little impact on the markets and on the economy. Some say it was because it was already priced in. Another view is that, well, there were so many other disruptions taking place that it became a little bit less relevant. The bigger context became more relevant. The stock market ended stronger than previously. Gold production, that increased significantly. The increase in commodity prices in the last few months has also really helped to drive growth in certain sectors of the economy. On the right-hand side, this is just an interesting perspective or snapshot of just a big platinum company. And here you can see the makeup of the basket of the revenue over time, pulled from financial statements. And what you can see is certain commodities really spiking and driving growth in this particular sector. So here we have rhodium and palladium really spiking up considerably in the last year. The reason for that is change in regulations, or a big part of the reason for that is change in regulations for carbon emissions in China and in the EU, whereby there's greater requirement for reduced emissions and use of palladium and rhodium. The rhodium price, and it's a real positive for South Africa. We've got about 80% of the global reserves of rhodium, and the price has increased from about 5,000 to 20,000 over the past year. So there are a few really big silver linings in amongst all of the challenges that we are facing. Obviously, the big question is, to what extent can we leverage off that? So in summary, if we look at this, all these different economic fundamental considerations that we've just gone through, there are a number of critical issues. So firstly, we have to grow the economy. We need to create jobs. We need to manage and look to decrease debt levels. We have to find ways of stimulating the consumer savings. Consumers on their own, they don't have those reserves. We need to find ways to encourage foreign direct investment. Increase the wealth of the population to increase the, try to then improve income inequality. So the question then is, to what extent were these key issues really addressed in the budget? Now, something that we like to do when it's this time of year is we like to have a little bit of fun, looking at the budget speech. And as we all know, the budget speech is largely comprised of two things, if you boil it down. The one is facts and figures, and the other one is the narrative. It's the message, the communication. What's the indication of the way that we're going to handle things? And so on the left-hand side of the screen, you can see some of the main words that we typically see in the budget speech. And on the right-hand side, you can see some of the standout words as we drill down to the messaging for this year. That was, increase in support, COVID-19, the frameworks, etc. So a little bit more of a shift on these other aspects. But to me, the most important thing that the minister said is that he explained that we are here today because we want to make difficult decisions. And he stressed that and he reiterated that. We are here today because we need to make difficult decisions. He went on to say, if we wanted to make easy decisions, well, we should go for a swim. And I think that's, to me, is the crux of it. And a lot is going to depend on the way that we go about carrying out the proposals that were announced in the direction in terms of spending and on the income side that the minister alluded to. So let's have a quick look at what the budget did say. If we look at priorities and the summary of government spending. So overall, the expenditure for the year ahead is expected to decrease slightly by 1.6%. The minister is trying to drive economic growth and economic stimulation in many ways. One of the concerning things you can see, and he did allude to it and stress it, is our debt service costs really high, 13% of GDP. That does constrain our future growth. Hence his desire and drive to try to reduce levels of debt, over the next 3 to 4 years. He did mention and stress that it is not an austerity budget. The intention is to still spend in the areas where we need to, but to really try to achieve longer term growth. The focus is very much on stimulating and driving the economy going forward. On the revenue side and on the expenditure side, there, as we saw, a very slight decrease in expected expenditure. Not much room there on the expenditure side. On the revenue side, what was very interesting is to see in terms of the trend of collections from SARS over a long period of time. It's been increasing from one year to the next. The revenue collection in terms of and the makeup of that has also changed over time. So on the right hand side, what you can see is in dark orange, personal income tax contribution to total revenue, corporate income tax, VAT, fuel, customs. Now this to me is a very interesting graph, because what we can see is the corporate income tax, the contribution from corporate income tax has been relatively stable for a number of years. On the other hand, the collections from personal income tax, that has increased considerably, and that's partly driven from broadening of the tax base. Other areas like fuel and customs, they increased, and then obviously in this last year, those consumption-based taxes really tapered off considerably. Not surprisingly, in 2020, overall, the revenue collections are down, compared to previously. And that a big factor for the personal income tax is obviously the loss of jobs, etc. That's impacted. Sometimes people having wage reductions, etc. Here we can see tax as a percentage of GDP. Now this is interesting, because it was increasing from 2017 onwards. It's then dropped considerably. Now tax collections lower, GDP also declined. Now, as a percentage, the minister explained that it's in the region of 27% is what it's expected to. Well, it's going to go up to about 28% tax to GDP. That is lower than the OECD average of tax to GDP. What's interesting, it is higher than the tax to GDP ratio of many other countries across Africa. And generally, when there's slightly lower levels of tax to GDP ratios, it can mean that we're being less efficient in terms of our collections of revenue, or it could mean that we're trying to stimulate and grow the economy. What we do know is that SARS has been very focused on driving and broadening the revenue collections. So I view that this is a bit more of a encouraging growth and trying to stimulate things. A concept that talks to this is the concept of the Laffer curve. Now, many of you will be familiar with this, but broadly speaking, the concept is that if you have a 0% tax rate, the government will make no money. If you have a 100% tax rate, the government will make money. Will not make any money, because no one will bother working. So the optimal level of taxation to optimize the revenue collections is somewhere in between. It differs for different countries. It's really difficult to get an exact pinpoint of what that point is. But there is a point at which, beyond which it's going to hurt and negatively impact the economy, and a point below that to which also revenue collections will decline. It's in the context of this and considering this that we should think about the reduction in the corporate income tax rate that we saw yesterday. There's been some interesting research and analysis that's been done in terms of the South African economy, in terms of where we are in relation to the Laffer curve. So here we've got the percentage change in total tax income over a period of time. And what you could see is that in the graph on the left-hand side, even though overall there were certain tax increases, it hasn't led to a further increase in revenue collections, which has led some people to conclude that potentially we are at a point where we had been overtaxed, and in order to stimulate the economy, it was necessary to provide a little bit of relief. On the right-hand side, there's a similar Laffer curve indicating VAT collections. So when the price of VAT increased to 15%, the VAT collections tapered off. Now, what makes this sort of analysis really difficult is it could be due to people not wanting to spend as much because the tax rate increased, or it could be driven because of the state of the economy and other factors. But in general, the Laffer curve conversation is an important one, and it is interesting to consider in light of the reduction of the corporate income tax rate yesterday. So if we look at summarizing some of the main features coming out of the budget from an economic perspective, no significant increases overall. Big support for the consumer. Now, we discussed earlier that the consumer saving levels were down. We don't have the luxury of the pent-up savings that we see in other developed countries. So we needed some stimulus. This stimulus came through in a number of formats, and in the next presentation, Yasmeen will go through that in more detail, some of those changes to what we've seen. Also, stimulus for corporates in terms of the tax rate. The other thing is SARS to focus on broadening the tax net rather than increasing the level of taxation for taxpayers. So all in all, if I consider the context, the crisis, real challenges from an economic perspective, and the constraints that the minister had, and the difficulty in maneuvering, it does seem like he did pull on a number of really good levers to do what he could to stimulate that growth. So the question now is where to from here? The government's produced an economic reconstruction and recovery plan. And this plan looks at, it's got various objectives, it's got priorities, that shows things that need to be done to achieve this. And it looks at protecting the low-income workers, building capacity, driving jobs, etc. It looks at the parts of the economy that need to be stimulated. So there is a plan for addressing and assisting the economy. It looks to focus on, in many cases, the industries and the parts of the sector that historically have had high levels of employment and labor force requirements. What's interesting is that the president recently said, though, when it comes to job creation, he said, and I quote, "The largest numbers of jobs will be created by the private sector in a number of industries as the economy recovers. We continue to work in a social compact with the private sector to create a more conducive environment for them to be able to create jobs. Our compact with the private sector is underpinned by a clear commitment to grow our economy and create jobs." Much of the focus in the ERRP that we just spoke about is focused on job creation. Much of what we need as a country is to increase jobs. That puts money directly in the hands of people who need the money. It helps to stimulate consumption spending, to increase demand, and really boost the economy. So the question to me is, what kind of jobs do we require? Now, this is interesting because At Graphene Economics, we do a lot of work for companies looking at their supply chains and business models, and we've had a lot of discussions over the past 12 months on factors that have impacted businesses, how technology has impacted them, how they've needed to make difficult decisions on funding, where to get funding from, how to sometimes pay workers in certain countries, how to address those real issues. To an extent, it's more focused in the last couple of months on expansion. How do we now look to grow? And there's all these continual questions of, well, the world has changed in many regards. There's a big drive on use of technology. Supply chains have been impacted, as we looked at previously. So what is the ideal route for job creation going forward? Now, we've done some interesting research to look at the countries and the economies that have typically grown the fastest as a percentage of GDP over the last, say, 15 odd years. On the left-hand side, you can see that worm chart showing that where countries have had a relatively high percentage of trade in services as a percentage of GDP, generally they've had really good long-term sustained growth. Interestingly, even if you have a look at the market cap of companies, so on the left-hand side, you see economies growing where they prioritize services. On the right-hand half of the page, you see the largest listed companies at the end of 2006. What's interesting is many of them produced physical products. On the right-hand side is the market cap in USD in 2020. And a number of these companies, they're a lot more service-driven. A lot of tech companies, some didn't even exist 15 years ago, 20 years ago. And so the composition of the largest companies itself has also changed, which tells us that there's a lot more room for growth in those sectors from a national perspective and a corporate perspective. And there are indeed a lot of benefits from focusing on trade in services. So increased productivity, less susceptible to economic downturns. This was interesting because what we found is that companies that were a lot more service orientated, when we had hard lockdown and we couldn't go into our places of work, many of them could start operating via Zoom or remotely from desktops. And they could adapt more flexibly and more easily than companies involved in making bricks and mortar type products. There's also a positive impact on growth of exports, and there's relatively low cost of deployment. Interesting story that I heard of recently is during the hard lockdown, there was a couple of people in one of the informal settlements in South Africa, and they realized that there was a need to be delivering goods to people who were vulnerable and could not travel and go to the shops. And they started an Uber type delivery system using their bicycles and WhatsApp. And they were charging a small fee for delivery to people. And there was great appreciation that there was a service that was beneficial to a number of people. So it can be deployed relatively cheaply and easily. So drive to create, to stimulate services is a really important consideration. I would also like to note at this point that services jobs are highly mobile. And this is something that we really need to consider as a country, because they will generally gravitate towards more competitive countries. The country offering the best opportunity for further growth is the one where those businesses are going to thrive and do really well. It's where people want to be in to render those services. So it's critical, especially with the use of technology being available. It's critical that we drive our productivity in this particular area. So the question is, do we have the environment to create jobs and build businesses at the moment? Just a few snapshots in this regard. So from a competitiveness level, what you can see is South Africa's ranking is approximately 60 in terms of the global ranking in this. So well done on where we would ideally want to be if we were looking to attract those service type jobs and other jobs and growth and really grow. The trust barometer. This is known to be a really important consideration of foreign direct investment. What's the level of trust in the economy and in the business? This is a snapshot, and it's interesting that this graph looked a bit different last year, but that's currently in the 2021 rankings if you look at the South African trust barometer, it's business that's got the highest level of trust. NGOs, the second highest level of trust. If you look at the global average, again, business is leading the way in this year. Last year, it was more skewed towards the NGOs in South Africa. This is really important. And I mean, here, if we drill down to the trust in business sector, here you can see across various different countries. Now, in some countries, overall, the levels of trust might be higher, but perhaps not in business or perhaps not in an individual sector. What you can see in orange is, and this is all coming from the Bowmans Trust Barometer report. In orange, you can see the countries where the population's level of trust in business is lowest. In dark blue, it's where the level of trust is highest. So South Africa, we regard it as having a relatively high level of trust in business. Now, I think this is important. I mean, the president alluded, as we saw a few slides ago, that jobs needs to come from business and growth needs to come from business. It's also interesting that a lot of the people that were surveyed said that they're expecting leaders in business to be standing up for social justices and other things. So there's a lot more expectation on business. There's more trust, but also more expectation. The ease of doing business is another challenge that we need to address if we are to achieve this much needed increase in jobs. As you can see, the perception of ease of doing business in South Africa has been dwindling quite a bit over the last several years. We've also seen companies facing constraints and challenges, so there are a considerable number of liquidations that we faced. Also, the number of JSE listed companies that have been around from 2010 to 2019, it has reduced considerably. It could be for various reasons. So consolidation of companies being one, just really difficult times and pressure being another factor, or looking to expand into other markets and rather have a listing somewhere else being another reason. Corruption is one of the elephants in the room. So here you can see from a corruption index, corruption perception index point of view, we rank 69th overall, based on Transparency International's corruption index. So also not particularly helpful. Another factor, and we have spoken about it today, about the drive for technology and the use of technology. South Africa currently, in terms of our capacity and readiness to adopt and explore digital technologies, we're ranking 60th out of 63 countries that were assessed. So that means if we are wanting to ride this wave of growth in technology and the opportunities that come with it, and there are challenges as well that come with it, but the opportunities, we do need to really improve on this. Utilities, we spoke about our SOEs just now, also ranking very low on the risk, on the barometer. So all of these factors creating a lot of challenges from a microeconomic perspective to help, that we have to work through in order to get to the point where we can even be looking to really create long-term, sustainable, meaningful jobs. So the question we have is, can we make the crisis a catalyst for change? Well, our big constraint is the very high debt burden. We don't have the luxury to just inject a lot of extra fiscal stimulus. We spend 2.1 billion rand daily on borrowing costs. Our debt service cost is one of the fastest growing areas of expenses. And it's exacerbated by the lower levels of tax collection compared to the budgets the previous year. We do, on the bright side, there are some potential stimulants if we are going to heed the minister's message to make those difficult decisions. And it's a really big effort. A lot of people have stressed this, like the budget, the market reacted strongly to the budget speech, but there is a really, really big if. It's, do we have the appetite, and are we willing to make these difficult decisions? Some points that could be helpful if we will make those decisions. The one is global liquidity. As I mentioned, it is highly mobile. Although we saw the countries that are providing lots of injections in terms of the stimulus packages, that gets into the hands of consumers. Consumers with extra savings, we've seen them increase their investments. Sometimes that's featured in emerging markets, etc. So the global liquidity can have spin-off effects for us. Low interest rates it's been given us a tiny bit of breathing room in terms of our levels of debt, but it can also be very helpful in terms of future expansion. Commodity price tailwinds. We spoke about rhodium, palladium, but the growth in the gold production, etc. The question is, are we going to miss out on this commodity boom, or are we going to be able to really take advantage of this? In terms of the fight against corruption, there do seem to be some positive steps being taken. It is very slow. It does add to the degree of positive sentiment. Technology is a really big one. It gives us access to markets. It assists with difficult challenges. For example, one of our big constraints and challenges is supply chains and procurement spend, etc. There is technology available that can be used to track procurement spend and manage that and give more transparency to it. So a number of the challenges we face, there is technology that can really equip us and help us. At the same time, technology does raise concerns about job losses, etc. From other previous forms of employment. What we need to consider is, are we making South Africa competitive for tech type companies to grow and develop and to encourage people to come into employment in that area? There are regional opportunities. We'll just talk through that very briefly, but the Africa Free Trade Agreement being one of them. Potential opportunities to reduce trade barriers and grow. We did have a positive budget speech, positive sentiment coming through from the budget speech. But as I said, it all does come down to execution and implementation. Won't go into too much detail in terms of the tech strategy. The Presidential Commission on the Fourth Industrial Revolution, it is looking at various criteria and looking at how to strengthen our tech capabilities. But it's really important, are we making it attractive for companies to grow their technology from South Africa rather than just using technology developed elsewhere? There are multiple benefits. We spoke about it can reduce some and impact some of our other challenges, improve return on investment of certain expenditure, and also we heard the minister, the minister yesterday talking of how the Commissioner of SARS is looking to use technology to broaden the tax base. Regional considerations. Our trade in Africa across the continent is much lower than it should be, both in services and in goods. There's some research that we've done at Graphene Economics that pinpoints and highlights the fact that to the extent we encourage trade in services across Africa, that can stimulate a lot more growth due to certain trends and the potential of trade in services. Likewise, with the Africa Continental Free Trade Agreement, there are a number of benefits that are available that are available to the extent that we tap in that. Benefits from the health care perspective, people living in poverty, addressing that, addressing revenue collections, etc. What we really need to do as a country is look to find ways to increase our competitiveness, drive the growth of the service economy, improve labor policies, reduce barriers to trade within Africa, promote and incentivize the South African technology sector, and optimize the Laffer curve. I was very pleased that I prepared this slide on Monday, and I was pleased that I didn't have to amend it after the budget speech that was given yesterday. In closing, my message to all the corporates in the room is that things have changed considerably, like the drivers of growth in many countries have changed. The use of technology, supply chains, etc. Consider your value chain and supply chain in light of the new trends. What you did yesterday, is it really still best for you? Understand the varying implications of the different markets in which you operate. They will be responding differently. Retain sufficient liquidity. We've seen debt levels increase in terms of corporates. Our analysis of corporates across the world, debt levels have increased considerably, but even more importantly, the affordability to service debt has increased. To make sure that you can endure future shocks, ensure liquidity is sufficient. Have a technology strategy. Those companies that are investing and focusing on technology are the ones that seem to be having better opportunity for future growth. Don't miss out on the second last point. There are hidden costs, and there will be hidden costs of technology. There will be, in time, likely to be tax considerations for use of technology cross-border. And lastly, we need to be engaging with policymakers to ensure that that we as business, we saw that the levels of trust in business are highest in South Africa and across the globe. We need to be engaging with policymakers to try to help with the direction that we're going in. We need to take up the heat from the president to work on that social compact between business and government. So in answering the question, is 2021 a year of crisis or catalyst? I'd say that just like a forest that has been devastated by a raging fire, there are sometimes green shoots that grow and that can develop and that can restore. And we are in a position where if we take up the minister's heed to make those difficult decisions, there are various tailwinds that we could take advantage of. Things will be challenging and they will be difficult. We've got a lot of work to do, but I do think that the budget of 2021 did set us in a much better direction than any alternatives. Thank you very much.
Thank you, Michael. It was really an informative presentation. I feel a bit challenged to live up to your standards for the next presentation, I have to be honest. So we're going to move on to the tax proposals now. I do apologize, I've got a bit of a frog in my throat today. Hopefully I don't end up croaking as well during the course of this presentation. So what I'm talking about today is the budget speech proposals, the tax proposals that were presented yesterday. And of course, it's quite useful to look back and see what the pre-budget speculation was prior to the budget speech actually being read. Now, if you look back in the media of the last few months, or especially the last few weeks, there's been a lot of talk about various new taxes that could be introduced. I think there was a bit of hysteria about the financing of the COVID-19 vaccines, which sounded a bit odd to me because in comparison to the total expenditure of our country, the amount to be expended on the vaccine is actually a very small percentage of the total. But having said that, I mean, there was a lot of speculation about new taxes being introduced. We know now that that's not the case, but it's worthwhile to dwell a bit on some of these potential new taxes and whether they could potentially be enacted at some point. The first one I want to deal with is the issue of wealth taxes. And the wealth taxes are, not something that has been implemented very successfully elsewhere in the world, but it's a concept that's not really an unknown concept. If I think of my own religion as an example, we do have a concept of a wealth tax, and what needs to happen in that case is that a person that is rich enough, who has enough assets, needs to distribute a portion of the assets to the poor people every year. I assume a wealth tax in South Africa would work on a similar sort of basis. Now, whether that is something that is a reasonable thing to be implemented remains to be seen, but I think it would certainly address a lot of the inequality. And certainly a lot of the researchers have shown or have commented previously that income tax actually doesn't help with wealth redistribution. Of course, if any wealth tax were to be implemented, the issue really is that we are, as Michael pointed out earlier, quite a highly taxed country as it is. So it's not so much the quantum of the taxes that we need to change, but really the incidence of that tax. Who needs to pay it rather than the actual quantum being increased? I was a bit alarmed to find that there was a study that was conducted and was published earlier this year, where they said, well, if a wealth tax had to be implemented on anyone that earned more than or owned more than 3.8 million rands worth of assets, that there would be, additional revenue of about 160 billion that could be raised. And that's quite a staggering number and quite a lot to take out of the economy in this kind of state. Then moving on to the other possible new tax that was proposed was going to be a temporary one, a solidarity tax, similar to the transitional levy that we had when we transitioned from apartheid to a democratic government. And that would have been a temporary measure to raise revenue in the short term. There was a lot of speculation about increased SARS audits on high net worth individuals, and we could see that that actually is coming to fruition. I will speak a bit later about what SARS is planning there. In the supplementary budget last year, there was talk of 40 billion rands of tax increases being implemented over the next few years. But it seems that that was based on the premise that our tax collections were going to be much worse than they actually ended up being. What helped us in the last few months was particularly the mining, the taxes on miners who ended up benefiting from the commodity boom and contributed a lot more to the fiscus. And then also the increase in consumption spending. And I think that was supported quite a lot by the grants that were provided by government in the last few months. So we know that as of now, no real new increases to tax rates are being proposed, and in fact, relief is being provided. From a corporate income tax and a dividend tax perspective, actually no changes were expected, despite the fact that government did indicate in previous years that they were looking at getting South Africa to be more competitive with other countries as far as corporate tax rates go. But actually, there was no real expectation that that would come into effect or be even announced this year. From a personal income tax perspective, I did a SNAP survey at a meeting I attended, an online meeting I attended last week with a few independent practitioners, and it seemed to be a mixed bag of predictions. So some said there's definitely more taxes on the horizon, whereas others said, well, we don't think that, the country can actually afford it or taxpayers can actually afford it. From a capital gains tax point of view, there was speculation that the inclusion rate would be reduced or be done away with completely. So capital gains would be taxed as normal revenue. I'm glad that that didn't come into fruition. For VAT, no real changes were expected. And I mean, the change that we had a few years ago made a big impact and wasn't really popular amongst the trade unions and other social commentators. So it wasn't likely to happen in the current year. A no-brainer is an increase in fuel levies and in sin taxes. I mean, those are areas where it's actually quite easy for government to extract money. And we can see those increases coming through. I'll discuss them a bit later. And then from a transfer duty perspective, nobody expected much change there. We had some changes last year, and nobody expected anything much to come through this year. From a sugar tax perspective, that's the so-called health promotion levy. Hefty increases were motivated from a health perspective. And I didn't see any mention in the budget speech on this particular tax. So clearly no increases are coming through. But I think we must think about what the sugar tax has done to some of our industries. It has had a major impact on beverage producers, but even more, a bigger impact on our sugar producers. And you must remember our sugar producers are big employers in this country. And a lot of them were badly impacted by the decrease in demand for their product. And then from an estate duty and a donations tax point of view, there were no real changes expected. Now, I found this particular quote when I was strolling through the net. And John F. Kennedy said this a few years ago, obviously before he was assassinated. He says, for every dollar released from taxation that is spared or invested will help create a new job and a new salary. And I think this is something that perhaps Treasury bore in mind or took heed of. I did see in the budget review that was published at the same time as the budget speech yesterday, that there was a study that was conducted and it was a study that was particular to this to our region, where I think the study found that actually the room to increase tax rates there was not much room to do that. As Michael mentioned earlier about the Laffer curve, I think what that study showed is we pretty much were either past that maximum optimum level of taxation that could be imposed, and maybe we're on the declining curve already. So moving on to the nuts and bolts of the tax proposals, and I term it a pleasant surprise, and it really was that. I mean, all of us who had feelings of bit of gloom and doom about whether we're going to have tax rate increases or not. Now, the impact of the on expected revenue collections was actually expected to be revenue neutral in real terms. Right? So in terms of real tax collection, so taking into account the effect of inflation, we expect to be revenue neutral. There are going to be cuts to the tax rates with effect from the 1st of March, and that's by increasing the brackets and rebates by 5%. And that is meant to reduce the tax revenue by 2.2 billion in real terms. And this is going to be offset by an increase in sin taxes and a new export tax on scrap metal, and that's expected to raise 2.2 billion. I find it quite interesting that Treasury manages to jig the numbers so they actually match. Last year, the same thing was done. I hope they have better forecasting techniques this year than they did last year. Then from a tax as a percentage of GDP, it's expected to be about 24.6%, which is slightly different from the number that Michael quoted earlier. This 24.6% I got from the budget review itself. So it's expected to be lower this year than it was in 2020. Now, if you just think about that, what it means is that for every rand we produce in the economy, 25 cents goes to the fisc. And you must remember that this is the amount that goes to the national fisc. It does not include the amounts that go to municipalities. It does not include the amounts that private individuals have to pay for things like security, schooling, healthcare, and so on, where some services are not adequately provided by the state. So if you had to look at an actual incidence of tax, you're probably looking at a much higher number than the 25%. The other number that was quite interesting to me was a tax buoyancy number. And this really indicates the resilience of our tax collections in relation to the performance of the economy. And in the current year, it was 2.39 compared to 1.16. So any number over 1 actually shows that the tax collections were more resilient than in the previous year. So what this shows that even though the economy went through a really rough patch over the last 11 months, actually tax collections are far better than it could have been otherwise. So moving on to personal tax rates, and I'm not going to dwell on this too much, except to say these are the bands that are now going to be in effect from Monday. Our lowest tax bracket ends at 216,000, and the highest tax bracket starts at about 1.65 million. The tax rates in each bracket remain pretty much the same, but effectively by widening the tax bracket, some relief and some money is being put back into taxpayers' pockets. Now, looking at tax rebates and thresholds, essentially for a person that's under the age of 65 years, the first 87,300 rands worth of your income is not taxable. And, the rebate has increased the primary rebate has increased from 14,958 rands to 15,714. So some welcome relief, not huge, but certainly better than it could have been otherwise. From a statistical point of view, I think the numbers are a bit concerning. I looked at the budget review yesterday, and it shows that about 14 million individuals are registered as individual taxpayers. Now, 14 million, if you look at our country, we've got an estimated population of about 60 million. That's actually quite a low percentage of the population. Of course, we must factor in that we've got children and that may not be income earners as yet, and so on. But it's a relatively small part of the population that actually registers as personal taxpayers. And of that 14 million, only 6.96 million of them are expected to pay any tax in the 22 tax year. So if you look at it, it's just over 10% of our total population that actually contribute to the highest part of the tax take. Remember in Michael's graphs, he said that personal taxes contributed to the bulk of, or there was the biggest contributor to the tax take. And that is really contributed by a very small percentage of that population. If you look at the highest marginal bracket, last year, we had 125,000 individuals in that bracket. And that made up 0.89% of the total taxpayers, number of taxpayers on SARS books. Now, what it's expected to do is actually decrease by 12,000 people to 113,000 in the 2022 tax year. And that could be a factor of many things. Some to come to mind. One is the fact that maybe incomes were hit with COVID-19. Some people have lost their jobs and they have to take lower salaries. But it could also be a factor of people actually leaving the country as well, immigration taking place. I've spoken to a number of tax practitioners. It's not something I dabble with myself because I focus more on corporate tax, but from speaking to other practitioners, it seems that quite a few people are planning to immigrate or have immigrated already. So, and it could well be that those people are in that higher tax bracket. And remember, they contribute of the total tax that's paid, they contribute actually a large chunk of it. Last year it was 27%, and this year it's expected to be about 26.5%. So it's a bit concerning that we're losing some of our higher paying taxpayers. Then just from a personal tax perspective, a few things. Medical scheme credits, there's an inflationary adjustment being applied. Now, this is a bit different from last year. I mean, if you think back last year, they gave an adjustment that was less than inflation. And the idea was to taper off these credits in time so that we could finance the NHI. I didn't find any mention yesterday about financing the NHI. So I don't know whether that's now on the back burner and we decided we don't really have enough money to do that. But for me, this is an indication that perhaps they're rethinking that whole NHI scheme and really rather provide the benefit so people can provide for their own medical in the meantime. From a UIF perspective, over the last few years, we haven't really had an increase in the ceiling for the UIF contributions. And that was because the UIF was one of those few funds that were actually solvent. You know, unlike the road accident fund, which is chronically insolvent, we do have the UIF that had quite a healthy balance sheet. So they could afford not to increase the ceiling over the last few years. Of course, we've now raided that fund by providing TERS benefits over this COVID-19 period. So there is a need to replenish those funds. So the ceiling has been adjusted to 17,700 rands approximately. So this means that at the maximum level, a contribution will increase from 148 rands to 177 rands a month. And something to look out for. Unfortunately, it's not going to be an immediate thing. It looks like it's going to be something considered over the medium term. National Treasury wants to review the current travel and home office allowances. And the reason for that, they say in the budget review, is the efficacy for simplicity of use, certainty for taxpayers, and compatibility with environmental objectives. Now, I don't know if that means that we could see them curtailing the travel allowances because it contributes to carbon emissions. It could well be the case that could happen. Now, because this has a big impact on salary structuring, it's expected to be a multi-year project. Now, you know, work from home is flavor of the month now because we're in the middle of the pandemic. But I'm not sure in a year's time whether we will revert back to what we were pre-2020. So it's it'll be interesting to see by the time these proposals actually come out, whether they're actually needed in that form. The consultations are to start during the current tax year or the current financial year. And it's hard to say at present how those consultations will pan out and what the changes will be made. Certainly from a home office allowance perspective, there's certainly a lot of room to simplify those rules. Then with regard to immigration, now this has been quite a hot topic over the last few years, particularly with the changes to Section 1110, and with a lot of employees working offshore deciding to actually break tax residency with South Africa. And one of the sticking point or the thorny issues has been access to retirement funds. Now, if you remember last year, the proposal was made that actually once a person ceases to be tax resident, they could not access the retirement funds for 3 years. So it became a bit of a sticking point because, you know, I mean, if you're immigrating, you're probably going to need that money. And to wait 3 years for your money and be exposed to potential, you know, exchange rate losses and so on, wasn't a good prospect for many immigrants. What I would like to do to discuss this particular amendment that's been proposed, I would like to refer this slide to my colleague Aniria Boa, who specializes in this area of taxation a bit more than I do. Aniria, if you can please comment on this aspect.
Hi, Yasmeen. Thank you. I mean, as Yasmeen mentioned, the change last year regarding retirement funds were quite controversial, and sometimes I think they were taken out of context because it only applied to preservation funds and to retirement annuity funds. And we received lots of panicked calls of individuals asking, should they resign now and immigrate in order to get access to their pension and provident funds? And those comments were not correct because the amendment only applied to preservation funds and to retirement annuity funds. And then also the change was necessitated because of the proposed change to exchange control regimes in order to abolish the idea of a resident for exchange control purposes. But be that as it may, I think that created a lot of panic in the market. The retirement fund changes which were proposed this year were in respect of mostly some changes in order just to facilitate savings. There were some comments regarding the ability to buy more than one annuity on retirement, transfers between different funds, and also just the valuation of employer contributions. And they are quite technical, and I'm not going into them, but they all appear to be fairly positive changes. The one anti-avoidance type provision which was included is currently when a person immigrates and they leave their pension fund in South Africa, they don't pay tax on the pension fund at the time of immigration. And if they can rely on a double tax agreement, there's a big likelihood that on the time when they become entitled either to a lump sum in terms of the retirement fund or to annuity payments, that the double tax agreement will give those taxing rights to the new country where they are then resident. So Treasury intends making some changes to that regard to ensure that they don't lose the taxing rights. We haven't received any details in respect thereof, and that it still remains to be seen what exactly will happen. I just want to make another comment in the cross-border context regarding working from home. Not only have we seen in South Africa people working from home, firstly because they have to, and now I read an interesting study this morning which indicates that most people do not want to return to the office on a full-time basis, but they like the hybrid model. And I must say the reference to the environment was quite interesting in that regard. Obviously, the more people work from home, the less cars you have on the road. So it's quite interesting to see how government is connecting the dots there. But what we are also seeing in a cross-border context is how people now realize that they don't need to, for example, live in London if they want to work for a UK firm. And that gives rise to some very interesting issues from a cross-border tax perspective, not only in respect of the taxation of the individuals, but also of the companies they work for. That hasn't been mentioned in the budget speech yet, or in the budget, so that is something which will also develop over time. And I would assume that government will also give it some time before deciding whether to make any specific or to introduce any specific measures in that regard. Thanks, Yasmeen.
All right, thanks, Aniria. I'm sorry, everyone. I see that I actually forgot to share my screen. One of those technical glitches I apologize for at the beginning. So please do forgive me. I hope you will get the slides later so you can have a look at them. Moving on to the next issue. So now, I'm not sure how to change my slide. I'm sorry, just give me a second. Right. Sorry. Now I can't see my slides. All right, here we are. Sorry, so I'm back to personal taxes. There is one particular amendment that's coming through in the budget review, which I thought was quite interesting, and it's related to a scheme to cede a right to receive an asset. And I thought it quite odd that particular attention or particular legislation is being considered for a scheme of this nature. Now, my understanding of the scheme is that a service provider or independent contractor will cede the right to receive or use an asset to be received from a person to whom the services are rendered or to be rendered. And the right is usually going to be ceded to a family trust for no consideration. The service provider circumvents gross income provisions as the asset is ceded before a value can be attached to it. And the service provider is not liable for donations tax as it appears they are disposing of a worthless asset. Now, the idea behind this change is that Treasury wants to take care or to prevent the loss of gross income as well as the non-application of donations tax. And I find this quite an odd situation because surely current provisions in our Income Tax Act already could be applicable, or for that matter, in our Tax Administration Act. If you look at the general anti-avoidance rules, I mean, a scheme of this nature seems to be quite contrived. I mean, as an individual, how can I provide services, but, sort of get rid of my right to receive the benefit of that service at a later stage, unless I'm in employment? And, we've got the general anti-avoidance rules, we've got gross income paragraph C, we've got the rules related to personal service providers. So it's a very odd situation to have particular attention being provided or being particular, if I can say, legislation being for such a specific issue. And my worry here is that when the legislation is drafted, it's going to catch far more than what the scheme is about. So more legitimate or rather legitimate transactions also being caught by this. Moving on. So moving on to employment, long service awards. Currently, there's a nil value fringe benefit provided for long service awards where assets don't have a value of more than 5,000 rands. And what came to the Treasury's attention is that employers can provide long service awards in a variety of forms now that could be regarded as non-cash benefits. So what they would like to do is to review and consider whether these awards within the same limits granted to employees as long service awards. Then from an employment tax perspective, there's a few schemes that are being used by employees and training institutions and are probably working in tandem. And the scheme essentially works around the training institution actually having students, which an employer, on which a company will claim employment tax benefits, even though that person may not actually be working for that company. Perhaps someone who's providing or is doing sort of in-service training or so, but really no consideration or no service, no salary is being paid to that person, or very low salary or stipend is being paid. Now, the scheme that sounds really wants to get rid of is that they want to curb schemes using these training institutions, and they want to then change the definition of employee to specify that work must actually be done or performed in terms of an employment contract in order to qualify for that ETI. And I think this provision makes sense because you actually should be providing work. It should be an employee that qualifies for the ETI, not just merely a student. The next aspect that I want to just discuss briefly is trusts. Now we know that trust tax rates remain unchanged. It didn't change yesterday when it came because the marginal tax rates remained the same. But with regard to Section 7C of the Income Tax Act, now if you think back, Section 7C was implemented in our legislation a few years ago. It came into effect on the 1st of March 2017, and really it attacks low interest or no interest loans provided by natural persons and certain companies to trusts and companies owned by trusts. Right? The impact of Section 7C is donations tax is applicable to these kinds of loans, so the interest benefit on these types of loans. Let's come to National Treasury's attention that the rules are being circumvented by the transfer of loans from a natural person to another trust to whom that natural person may be related or but not necessarily a connected person. And so if essentially what Treasury is going to do is look at trust-to-trust loans that are sort of contrived. Now, I would have thought that this may be caught already in terms of our legislation, because the current rules do provide for when a loan is transferred or is assumed by another person, you can have Section 7C applying to those loans. So I've had a situation with a client where a trust inherited a loan that was from a deceased person, and that loan was made to another trust. And Section 7C, we concluded, was going to be applicable on the loan between the two trusts. So it remains to be seen whether it's necessary to actually have the changes that Treasury wants to put in place. The worry with this is that when the legislation is drafted, it may well be that all trust-to-trust loans may actually be caught in this. So we'll wait to see in July when the legislation is published to see what the impact would be. On wealth taxes, generally, those remain unchanged. There were no changes proposed to CGT, estate duty, donations, transfer duty. So those remain pretty much the same as they were in the 2020 year. From a VAT perspective, there was no rate change, but there were a few other proposals that may have impacted to certain parts of the economy. The first proposal was a positive one. It relates to superfine maize meal. Now, this is a different type of maize meal that's been than what is already catered for in our VAT legislation. And this type of maize meal will now also qualify for the zero rating. They also want to put in provisions into the legislation for microinsurance. Now, I wasn't sure exactly what microinsurance was, and when I looked it up, it's apparently insurance provided to low-income people, and it seems that that insurance could well have features of short-term insurance and long-term insurance. It's not quite clear what provisions will be made. Presumably, the provisions will be similar to the existing provisions in the legislation, where long-term insurance or products that have long-term insurance characteristics will be treated as exempt supplies, and those with short-term characteristics will be treated as taxable supplies. But again, it remains to be seen because the actual nuts and bolts of these provisions are not available as yet. Then with regard to the temporary letting of residential property. Now remember, as a developer, there was a problem with the property market where a lot of developers weren't able to sell their properties and had to opt for temporary letting of those properties in order to generate some income. Now, when that happens, there's a clawback of that needs to happen. But the problem with it is that the clawback of that VAT is disproportionate to the amount of money you actually generate from the rentals. So there's an amendment that's going to be proposed to look at an equitable formula and a value and a rate on the clawback of that VAT for developers. Then there's going to be measures introduced to curb the undue VAT refunds on gold exports. Now, I am aware in this industry, there's apparently a lot of skullduggery that's going on. There's quite a big investigation that SARS has been conducting into the industry over the last year or year and a half. And what they're looking to do is put in place new regulations to provide for a domestic reverse charge mechanism for the industry. And what it seems like how this will work is that a vendor that acquires gold from another vendor will declare and pay the VAT over to SARS. So in other words, the customer and not the supplier will pay the VAT over to SARS. Now, it remains to be seen how that will fit in with our normal VAT provisions and VAT reporting, because it's going to be very odd for the supplier of the gold not to account for the VAT on this particular supply. The other question that comes to mind is whether this will now be applicable to gold coins that are normally zero rated. Now remember, gold coins, like rands that are issued by the Reserve Bank, are generally regarded as zero rated. I'm aware that in SARS investigations that those gold coins, there's allegations that those gold coins were being melted down and used and recycled illegally as well. So it'll be interesting to see whether they expect that this particular VAT provision would also apply to gold coins as well. Then from a corporate tax perspective, currently the income tax rate is 28%. It will be reduced to 27%. Effective for the years of assessment commencing on or after 1st of April 2022. Now, it's been announced, it hasn't been enacted as yet, but I think companies must start thinking about the deferred tax impact, the potential deferred tax impact of this provision. Remember, First of April 2022 is that it'll be applicable for any years of assessment commencing on or after that date, which means that the first time, for example, for a December year end, that this rate will be applicable will be the 2023 tax year. But you may have to adjust ahead of time your deferred tax to account for it at a lower rate, whether it's an asset or liability, it needs to be adjusted perhaps to a lower rate earlier in your set of financial statements. Now, how will this 27% rate be achieved in a tax neutral manner or revenue neutral manner? They want to do that by broadening the tax base, the corporate tax base. Now, it was a 2020 proposal to limit the utilization of assessed losses. And if you remember, the proposal last year was that they were going to broaden the tax base by restricting the offset of assessed losses carried forward to 80% of the taxable income of a company. So if you have a company that has got an existing assessed loss brought forward, but you generated the taxable income in the current year, you would still pay cash tax on 20% of your taxable income. Now, for a lot of companies, this is not really an issue. If you are actually profitable and have the assessed loss because of allowances that you were able to claim, but thinking of a company that's digging itself out of a hole because it's traded badly, this would be an additional burden that would be placed on a company that's just starting to see the light. In terms of the effective date of this proposal, it was meant to come in on the 1st of January 2021. It was pushed out because of COVID to 2022. And it's uncertain at this point whether it'll come into effect on the 1st of January 2022, or it will come in or coincide with the reduction in the corporate tax rate. Also announced last year was the limitation of excessive interest deductions. And essentially, they wanted to increase the scope of the existing interest limitation rules. Now, remember, we do already have interest limitation rules in our legislation. And it's really, this proposal is meant to strengthen those rules. Originally, when this proposal came out, there was a concern that it would apply to all interest and not only connected person interest. It seems like they've rethought that and have confirmed that this will be restricted to connected person interest instead of total interest. And then, of course, they are removing certain incentives. That was announced last year. And on the next slide, let's discuss which incentives those are. The ones that are definitely moving out or not going to be extended any longer will be the VCC incentive. So that will not be extended beyond 30th of June 2021. I think there was a study that Treasury did on the VCC companies that exist currently. And their conclusion was that the majority of the beneficiaries of the VCC regime were high net worth individuals. And the VCC companies didn't actually create the level of employment that they were targeting. So that announcement has come through that beyond 30th of June 2021, this incentive would not be extended. There's also sunset dates for certain other incentives, like the airport and port assets, rolling stock, loans for residential units and firms, and affected taxpayers are afforded the opportunity to make submissions to potentially retain those provisions, but it doesn't look likely that Treasury wants to keep these in our legislation. Section 12I incentive has already come to an end, and it's only those last few people or companies that have applied and have been approved that can continue claiming these allowances. The one piece that is quite positive is that if you couldn't meet the timelines to have the assets brought into use by the time, because of COVID, then government will consider extending the time frames for bringing those relevant assets into use. But it seems to be on a by application basis and on a case-by-case basis. There's not a general extension of the 12I regime. On a positive note, though, as far as incentives go, the urban development zone allowances and learnership allowances have been extended for 2 more years. The urban development zone allowances have been quite successful in getting the urban renewal projects off the ground. And if you look at the CBDs, and I'm talking about Durban at the moment, I mean, it's quite in a state of decay. And there have been quite a few projects that have actually uplifted certain precincts. And it's to be hoped that it will be more extensively used so that the CBD can be upgraded. From a learnership allowance perspective, this ties in very closely with the whole idea of developing skills and creating employment opportunities as well. Those learnership allowances have been quite successful. For the companies that I've been involved in, it certainly has been good from a training and employment perspective. That's been extended for 2 more years, and it remains to be seen whether it'll be extended any further. The one other allowance that is coming to an end or meant to come into an end next year is the R&D allowance. That's meant to come to an end on the 31st of October, 2022. National Treasury is going to publish a discussion paper on this. I know they've started consulting with the relevant parties in the industry to get information to see whether this should be extended. I think it's likely it will be extended because there is a focus on developing local knowledge to encourage innovation, local innovation, and other countries around the world have similar regimes. I think we would be uncompetitive if we let it lapse. Then from a rollover relief perspective, if any of you are in larger corporates or corporate environment and you end up restructuring part of your group, these are the kind of rules that you would use. The section, typically from section 42 to section 47 of the Income Tax Act. And yet again, there's going to be a few amendments. I'm going to hand over to my colleague Bokola or Renee to please speak to these. Essentially, what it seems like is that there are going to be some relaxations. Most of them seem to be in favor of the taxpayer. But I think the bottom line is that if you are intending to undertake any of these kind of transactions in the next year or so, just be aware that these provisions are going to be amended. Renee, Mohala, do you have any comment that you'd like to share with our participants?
Thanks, Yasmeen. Look, I guess I can talk to the Section 46 amendment. It's something that I've been involved in. I did spend some time also making submissions to the National Treasury and also in Parliament. What I'm seeing here with this proposed amendment, I think it's an attempt to soften the blow. Because what this means, that what the amended section means now, with effect from October last year, is that in the event of an unbundling transaction, there's going to be an apportionment if you have a substantial shareholding in the unbundling company by disqualified persons. And as we know, the tax liability in those cases, the different types of liability, one being the dividends tax, which may be relevant where you're dealing with foreign shareholders and assuming that the treaty doesn't shield them from the 20% rate. But it also has a CGT cost for the company itself, because the company is deemed to have made a disposal of the shares that it unbundles to its shareholders at market value. So, in the event that the company has a low base cost in respect of the shares that it unbundles, obviously that can be quite a exercise, and it can have a cash flow impact for the company, because the company not only will have to fund the tax liability, and that may mean some of its assets to fund a tax liability which it wouldn't have had before 28 October last year. But the concern that was raised during the interactions was that ultimately, this tax liability is indirectly being borne by shareholders that are not disqualified persons, because essentially they're not the ones who caused the problem. They don't fall within the list of disqualified persons, and yet they're affected by the unbundling, in the sense that the company has to find a source of money to fund the tax liability. And I think this is an attempt to sort of cushion that particular blow. There is a bit of confusion in the budget speech in the way in which this proposal is worded. But what I understand is that to the extent that the company becomes liable for tax as a result of an unbundling transaction and in particular an unbundling to a disqualified person, they will give a step up in the base cost of the remaining shareholders, the other shareholders who are not disqualified persons. As you know, the way in which Section 46 applies is that when there's an unbundling, you have to spread the base cost of the unbundling shares between the two sets of shares. You reduce the base cost of the shares in the unbundling company, and you increase the base cost of the shares in the unbundled company by the same amount. So it looks like, in addition to that, there'll be a slight uptick in the amount that's allocated to the base cost of the unbundled shares, just to give, to lift up the base cost. And obviously, the idea is that on subsequent disposal by a shareholder of these shares, the amount of CGT that they would be liable for is slightly reduced because they have a higher base cost. I think there's likely to be quite a debate about whether or not this goes far enough, because it still requires the company to find a source of money to pay for the tax liability. And if you're in a listed environment, this can be quite a substantial amount of money for a company to have to find. So it does still. I don't think it goes far enough to incentivize companies to consider unbundling transactions. But that's a debate I think that will probably start in earnest when the draft bill comes out. I think, Renee can also jump in here, because these are the provisions that generally we work together on the other proposals. But I think what I'm seeing is, again, it's sort of an attempt at trying to soften the impact of some of these anti-avoidance provisions, because these proposed amendments relating to Section 42 and 45 are primarily aimed at the anti-avoidance parts of these different provisions, and there's an attempt to sort of align them and also to avoid sort of a double penalty in certain instances, so that when one of the anti-avoidance provisions applies, the other doesn't apply. So it seems as if it's, that's an attempt to try to create a sense of fairness in the application of these provisions. Renee, I think I've been talking to you.
Thank you, Mkhula. Maybe shortly I can raise one red flag with regard to Section 42, which contemplates an asset for share transaction. In other words, a transaction in terms of which a company acquires an asset in return for the issue of shares. If that company, in addition to the shares, also assumes debt, that debt can have tax implications for the seller of the asset at a future date when that person disposes of the shares, and that will no longer be able to address through, or it cannot be addressed through consecutive rollover relief provisions. Similar to the degrouping charge in Section 45, that latent tax liability will roll over, and as soon as a transaction occurs that's outside of tax rollover relief, the tax will be triggered. Thank you, Yasmeen.
Thank you, Renee. You explained it very eloquently, both you and Mkhula. Thank you very much.
I suppose one thing that Renee and I should be mentioning is that once again, there's a glaring omission of any proposal relating to the amendment of Section 47 of the Income Tax Act. That's the one that deals with liquidation distributions. I think, at some point something has to be done, because there's always uncertainty whenever we work on these types of transactions, trying to understand or find a way to marry the provisions of Section 47 and the provisions of the Companies Act. For some reason, it just looks like, once again, maybe, like making too much out of this, but this would be an ideal opportunity to just to also address it, and for National Treasury to address it, or at least into what the sort of the practitioners are saying about the challenges of trying to marry the two sets of legislation, because you can't implement any of these transactions. Actually, it's mergers, section 44, mergers, pardon me, is not section 47, how to marry the two pieces of legislation, because you can't do transactions without complying with the provisions of section 44 of the Income Tax Act, and without complying with section 113 of the Companies Act. I think it's an opportune moment to do that, since they're relooking like the other section in the event.
Thank you, Mokola. Really appreciate your insights there. I see that we're just running over a little bit on the time. I do apologize to our attendees. Just bear with us a bit more. There are a few more proposals that are quite important for you to be aware of and start planning for as well. From a corporate tax perspective, there is a provision that is proposed for the contributed tax capital to address some abuse related to the allocation of CTC on the basis of alleged share premium contributed by a particular shareholder, and not by all shareholders within the same class. And really, I think what Treasury wants to make quite clear is that the principle that should be applied is that shareholders within the same class should share equally in the allocation of CTC, and one should not be allocated more than another within the same class. From a hybrid debt rule perspective, there is a change being amended in favor of the taxpayer, but we found it quite odd because we thought this was catered for in the legislation already. National Treasury believes that the current wording of the hybrid debt provisions could result in interest being reclassified as a dividend in the hands of the issuer, but the amount may still be regarded as interest in the hands of the holder. Now, that hasn't been our interpretation of the relevant provisions of the Act, but if essentially what Treasury wants to do is propose, and they proposed an amendment to address this concern, which is welcome, but does raise a concern whether past interpretation has been flawed in some way. From an international tax perspective, South Africa is participating in the multinational tax processes and agreements, including the international agreements to finalize a treaty on base erosion and profit shifting. South Africa has signed but has not ratified its participation. And there is a proposal that government will renegotiate some bilateral treaties where the other party or the other country has not signed up to this multilateral instrument. South Africa is also part of the steering group, which is examining income tax challenges associated with the digital economy. There was a commitment by the G20 countries to reach consensus by the end of 2020. And unfortunately, that was delayed by the pandemic. And should efforts fail to reach consensus by mid-2021, South Africa will consider the appropriateness of a unilateral approach. So if we don't see any action in the next few months, South Africa could end up enacting its own rules to potentially tax or try and tax some of these larger digital companies. From a royalty withholding tax perspective, there is an anomaly or an omission in our legislation that where a recipient is exempt from royalty withholding tax, there's no requirement that that person needs to provide a declaration to the payer of the royalty, and that is just going to be changed or made clear that that needs to happen as well. And from a controlled foreign company perspective, there's some rules being changed in Section 9D. I would like to ask Robin Berger, if she's still on the line, to actually talk us through some of these changes, because she's far more conversant with these rules.
Thank you, Yasmeen. Morning, everybody. The diversion rules are rules that deal with connected party South African resident transactions, where the controlled foreign company is either buying from or selling to those parties usually. And here the idea is that these anti-avoidance rules will be tightened further to make sure that certain loopholes clearly that have been identified by SARS will be addressed. The that many of you might be familiar with the concept of loop arrangements, whereby previously it was not permitted for South Africans to invest into foreign structures that then invest back into South Africa. And rules were introduced with effect from the 1st of January this year, which now allow those types of structures to proceed unchecked, well, not unchecked, well, without limitations, I should say. And when they made these changes, it was critical for them to protect the tax base, and therefore certain changes were made to tax laws, one of which is that when you sell shares in a foreign company, very often you may qualify for an exemption on those share sales. But here what they've done is they've carved out that exemption to the extent that those assets relate to South African assets. And what they didn't do is adjust the ceasing to be a CFC rule. In other words, when you sell your foreign shares, usually those companies stop being controlled foreign companies, and then you have deemed disposal rules that apply. So they need to now marry all of these provisions together. Thanks, Yasmeen.
Thank you, Robin. Moving on to the financial sector, there is a new levy being proposed for the financial sector to fund the regulatory authorities, the Prudential Authority and the Financial Sector Conduct Authority. So something new to look forward to for financial institutions. Then from a withholding tax perspective, the rates remain unchanged for dividends, royalties, and interest paid to non-residents. I'm not going to dwell on that too long. With regard to export taxes, if you remember, one of the areas where we're going to collect more tax from is the export of scrap metals. The new tax was introduced in last year's legislation to reduce the unfair trade practices in this area. It was meant to be effective on the 1st of March, which is Monday. And essentially, SARS is not ready and either our taxpayer is ready for this tax. So the effective date has been postponed to the 1st of August. From a fuel levy perspective, the fuel levies have been increased in line with inflation. So that's why they don't expect any real increase in taxes due to fuel levies. We expect on the 7th of April, the fuel levy will be increased by a total of 27 cents. That's 15 cents going to the general fuel levy, 11 cents to the road accident fund levy, and 1 cent to carbon tax. The percentage of tax included in the pump price is actually quite high still. It's still around the 40% mark, and for diesel, 44%. So a substantial amount of the money that we pay at the petrol pump actually goes to SARS. From a diesel refund perspective, just to be aware that legislation is being redrafted. The second draft has been published and it is available for public comment now, and the consultation process is still going to take place. From an environmental tax perspective, there are a few things on the carbon tax that I just want to highlight because it's of relevance to some of my clients that may be on this call. The first is related to the carbon budget. A lot of taxpayers or larger taxpayers participate in the carbon budget process with the Department of Environmental, Forestry and Fisheries and Forestry. And if you merely participate in that process, you can currently obtain a 5% allowance or reduction of your carbon tax liability. Now that's going to be applicable until the end of next year. And following that, they're considering actually putting in place carbon caps instead to limit the amount of emissions companies may make. And once that's enacted, the budget allowance will be phased out. From a waste tire perspective, there are quite a few companies that use waste tires or burn waste tires as a fuel source. Because the emission factors are not currently included in our Carbon Tax Act, actually no, the carbon tax is actually payable on this type of fuel source at the moment. That's going to change because the DFF is going to be developing emissions factors, and they expect that they will announce that in the 2022 review. With regard to the other changes, I'm not going to dwell on them too much in the interest of time, but just to be aware that there are a few more industries that are covered now by carbon tax, and there have been a reduction of certain thresholds on the carbon tax applicability. So for example, if you're a brick manufacturer, the threshold at which carbon tax becomes applicable has been reduced. So it's at a lower level of volume that companies will be now subject to the carbon tax. So just to be aware that there are these new entities or additional entities that are now going to be subject to carbon tax. From a plastic bag perspective, the current levy is 25 cents per bag. We do have bio-based plastic bags, which are made out of renewable resources. They are a bit more eco-friendly, but still pose a littering and marine pollution problem. That there's going to be reduced levies on these bio bags at 12.5 cents per bag. Then from an alcohol and tobacco perspective, I'm sure you guys must have seen this. They increased excise duties by 8%. There's a bit of an outcry because of the extent of the illicit economy in this area. Essentially what this means is that legitimate taxpayers will pay more, and possibly the illicit economy, also some commentators say, will actually be bolstered by the fact that legal cigarettes and legal alcohol will actually cost more. There are going to be new excise duties being imposed on heated tobacco products. That will come out later this year. Then from a tax administration perspective, there is one big change that I just want to highlight. And this is for public benefit organizations. There has been a problem over the last few years that individuals and companies have been claiming Section 18A allowances or deductions based on certificates issued by certain public benefit organizations. And it's come to light that in some cases, unapproved organizations have been issuing these 18A certificates. You would have noticed there's a lot of, SARS is doing a lot more enforcement in this area, certainly inspecting or requesting copies of the Section 18A certificates before they grant the deduction. And one of the areas where they're looking to try and increase or improve SARS matching capabilities is to extend third-party reporting to cover Section 18A certificates. So in other words, public benefit organizations need to report to SARS the number and the amounts of the certificates that they actually have issued during the year. It's a bit doubtful whether they will have, the public benefit organizations will have the capability to do this kind of reporting, and within the time frame SARS normally requires. They normally require it 2 months after year end. And knowing that the resources at a public benefit organization level is quite constrained, it's a bit questionable whether they will be able to meet this requirement. From a SARS perspective, something to note, there is going to be a dedicated unit being created for high net worth individuals. The first group of taxpayers have been identified already to be part of this unit, so I suppose it will work similar to the LBC for larger corporates. Communication is expected to these individuals in April 2021. I don't know if that's communication to say that you are going to be part of this, this new center they're creating at SARS, or whether it's going to be an audit communication. And there's also going to be a larger focus on consolidating wealth data through third-party information so that it can identify those high net worth individuals that are possibly not declaring the full amount of tax or wealth. Then from a tax policy perspective, there is a tax regime being considered for the upstream petroleum industry, and that's largely driven from the large gas finds near Mossel Bay. So something to look forward to for those taxpayers that are involved in that industry. And with that, I must end. I apologize again for messing up on the slides earlier on. As said, my age is really showing, and I didn't realize that I didn't have the slides on display. So once again, my apologies for that. I apologize again for going over time. I do hope you got some benefit from this presentation. I do hope that you will join us again at some point in the future. Thank you. With that, I'm going to open the floor to questions and answer the questions.